Hey, welcome back, everybody. It's Friday, March 22nd, and it's time for a general market update. Just a reminder, I'm an individual growth stock investor not affiliated with Market Smith or Market Surge and IBD. Okay, the agenda this week. I thought we would go back in history a little bit, take a look at the 1962 and the 2003 historical markets, particularly how those bear markets recovered off the lows. Then we'll talk about M is for market, and we'll talk about some of the distribution we've seen in the NASDAQ. Then we'll get into the more on the indices and some of the internals, and then we'll wrap it up for the week. So 1962 and 2002. So what you see on the screen here on the right side, this is the S&P 500. This is a chart from 2022 to today. And I showed this comparison with the 1962 market back in June of last year. So I think it's a good time to take a good look at it again. 1962 was another bear market. And what we noticed at the time was, this bear market had three waves down, got a follow through day, and then we had a retest of those lows. In this case, it was due to the Cuban Missile Crisis in the 1962. And then from there, after that retest, we had a nice run up. We had a 5% pullback. And wanted to look at that in conjunction with the market that we've been through. So over on the right, we see this is 2022 bear market. Pretty distinct three waves down, very similar. You can see that we had a follow-through day, and then we had a retest. And our retest was about a year ago when we had the regional banking crisis. It looked like things were going to get very ugly, but they held up. So we moved up and rallied, and then we had that long 3-month correction of about 11% on the S&P. So I was just looking at the what was the gains in bull market year one, 1963, which was the first full year of a bull market. That market moved up about 17%. If you had a similar comparison, our bull market started in late 22, but really in 2023, about a 23% gain. So just looking ahead, look at the bull market in 64, there was up about 12%. And you'll notice that in 64, the market moved up fairly steadily, got to be about 12% above the old highs before we had a deeper little pullback of about almost 5% back to the undercut of the 10-week moving average. So in our case, we've had this run up, we've exceeded the old highs, which I've shown with this zone here, and we're about 8 to 9% above the old highs, and we're in bull market year number 2. There's probably going to be a pullback of some degree, and we'll talk about some of the reasons why we believe that. But it was interesting to look at this. Not that they're trying to predict anything here, but it is a good reference point. And I also took a look at the 2002 market recovery. So same thing. The S&P today is on the right, but here's the 2002, 2003 bear market and recovery. And this is the last leg down in 2002. We had an undercut of the lows, then we had a little rally, then we had a retest of the lows, and then we had our first sustained move up, which had about a 5% pullback along the way. And then that market, which was a devastating bear market, got near this peak here. The market really did pause. The correction was not terribly deep at 9%, but you can see it was a 23-week correction in bull market year number 2. And you can see multiple closes below the 40-week moving average here. So this was a long, drawn-out correction after the first leg up, but we were still below the old highs. So it's a little bit different. Again, just trying to look at some reference points. It certainly feels like we're going to have a more substantive correction at some point, but that's just predicting things, and we don't want to predict things. So take it for what it's worth. It's just some reference points. So going back to 1962, I wanted to show, there's a lot of people today saying, hey, the market's overvalued fundamentally, and some people say it's undervalued. And again, we need to follow price. Okay, that's our number one indicator is price. And back in 1962, Shavako Capital put together this slide. And back in 62, Warren Buffett had an indicator model that looked at overvalued and undervalued. And he had said consistently throughout this period in the 60s that, equities were overvalued. So you can see here from the points that he was saying is overvalued, the market ran up 88% over the next 8 years. So don't get hung up on overvalued and undervalued. We want to follow price and follow our instruments on the market trend. So M is for market. So being position traders and the foundationally being can slim traders, the market is what the M stands for. Now, many people would say you should reverse the M and the C, and it should be called man slick. I know that the New Jersey meetup looks at it that way. Because the market is so important, maybe it should be the first letter in your evaluation of stocks. The market environment is very, very important. We know as growth stock investors, we need an environment of an uptrend, hopefully with an accommodative Fed to help be a catalyst for growth stocks. So let's look a little further into the distribution that we've been seeing over the past 2 to 3 weeks on the NASDAQ. And I've called up an historical chart. So essentially, market tops are created in 2 ways. You can have a climax top, or you can have really what I call a distribution top. Distribution tops don't mean the entire uptrend is over, but it definitely means there might be a pause, or maybe there's an intermediate term correction of 8 to 12% when you have a lot of distribution. So here's the 2007 distribution top in the NASDAQ, and I thought this would be a good thing to walk through. So I've marked here the distribution days and also some commentary. You can see that we typically get distribution on the way up on an uptrend. That's kind of normal to have a few distribution days that are spaced out. But you can see here, this big reversal day was distribution day number 2, pretty big volume. So we have a reversal on high volume and a big range. That's a clue that things are a little bit different. Now, 2 days later, there was another distribution day, you can see here, with a very weak close. Those 2 distribution days probably should have had you looking at selling your weakest stock if you had a series of stocks. We get another distribution the very next day. You can see right here, distribution day number 4. So now we have back-to-back distribution. We probably should be selling some more stock. Then we get a pretty soft rally in here. And then we get hit with a very bad day. We get a big reversal on distribution day number 5, and we close at the absolute lows, breaking the 20 EMA. So this actually creates a distribution cluster, which is usually 4 distribution days within an 8-day period. And things look pretty bad here. And at that point, you should be exiting all your positions, most likely, except maybe your strongest stock, which you have cushion. That would be the one you're trying to hold on to. So in this case, in 07, the market tried to rally for a couple of days. These blue days with nice peak closes looked pretty good. But you can see here, the market had another distribution day, distribution 6. So we're clustering again. And then we have this rally attempt for almost 4 to 5 days. And then we get this day here where we break out and close at new highs. And this turns out to be the expectation breaker. And what I mean by that is it's an expectation breaker because when you have this day here and you're at new highs, you expect the market's going to follow through and we're going to go to new highs. Well, the very next day, we get hit with another down day. And it was a couple days after that, the market really, really fell apart. The expectation breaker day here, where we turned and reversed, that really was the final signal to really exit all your positions that the market was going into a correction. And we gapped down on volume and it got worse. So this is just an example of these distribution day kind of tops. So let's relate this now to our current market. So this is the NASDAQ, and it's showing the current NASDAQ. So I want to take you through some of these distribution. We've been seeing distribution now for 3 or 4 weeks, and it's clustered in the last couple of weeks, a little more than we'd like. So again, let's call this distribution day number 1. It's a few days later. We get another distribution day. Nothing terribly concerning yet. All of a sudden, we gap up and we think we're going to move higher. And a couple of days later, we have what we call a stall day, where we made no real progress, but the volume picked up. So I've marked that as S for stalling. You can see here that the market traded tightly. Then we got another day where the volume picked up and we just couldn't move higher at all. It's another stall day, subtle in the chart, but it's a form of distribution, not outright distribution, but it's stalling. Again, you can see here that we tried to move up to new highs, got to a new high, and then we were hit with distribution. I marked that down as number 3. And then we had another distribution day. So back-to-back distribution days, which we don't like to see on increasing volume. Then you can see here the market tries to make a new high and reversed. This is really the expectation breaker that we had 2 weeks ago. I think it was Friday. This is the expectation breaker. We thought this market was going to continue higher, and it didn't. So that's a real caution sign that maybe you could look at the distribution that's occurring. There's quite a bit. And you look at really the market had made very little progress for 3 or 4 weeks. Essentially, if I drew a line between these closes and over here, not much progress. And you can see here we had distribution again this week on, I believe this was Tuesday and Wednesday, I believe it was, or maybe it was Monday and Tuesday. And then we had the Fed meeting, and the Fed meeting, gave us a little pop on Wednesday at the end of the day. Thursday, was not that impressive. The market gapped up, finished closed at the lows. That was not great. Volume was not really good behind the follow through there. And even today, it's been fairly muted. The volume's low. So this is really a caution sign. Could this be the expectation breaker before we really have a trap door and fall down? It's possible, but we'll have to just take it day by day. But a lot of distribution in here. The market's trying to fight off correcting. So let's go further into these indices a little bit and look at the market internals. This is the S&P 500 as of today. What can you say? The market in the S&P has held up stronger than the NASDAQ. You can see in purple, this is the 20-day exponential moving average. It's held like a charm. So the uptrend is still trending up. We've hit a new high on the S&P a couple days this week. The volume, though, is pretty weak today. So again, I'm a little concerned that we might have an air pocket. But there's no doubt that the new highs on the S&P have been supporting and confirming some good action in the S&P. The rotation that's occurring under the surface is leading the industrials and the material stocks and even energy to support the S&P. And don't forget, the S&P also has some of the big Mag 7 stocks in it that are also doing well, like NVIDIA, which are keeping this index fairly strong. Now on the NASDAQ, we just took a close look at the distribution, but yesterday's volume was not that impressive as a follow-through day to the Fed day. So I'm a little concerned about an air pocket. But the new lows, on the positive side, the new lows have dried up, and we're starting to see some more net new highs. What we've seen is those leading stocks that had paused for a week or two have popped to new highs. So that's why the new highs are increasing. And the good news is the new lows are drying up below 50. So that's encouraging. Like to see some more volume to confirm that we might be making another leg. Now, this is a chart of 2 ETFs. I've taken XLP, which is consumer staples, and I've divided them by the SPY. So generally, when you look at this ratio, if the line is going up, it's telling you that the staples are outperforming the S&P. And when we're in a bear market, portfolio managers are moving into defensive stocks like consumer staples, toilet paper, toothpaste, canned soup. So you'd see this action in a bear market. So ever since our bull market has started in 2023, you see the lines moving down. That means the S&P is outperforming. So defensive staples are lagging the S&P. In fact, staples are at new lows. So what this chart is telling us is that, the market is not moving into defensive staples. So that's good for risk on. Now, another ratio is looking at energy stocks, and I took the XLK, which is tech stocks, and taking tech stocks, we divide that by the XLE, which is energy. So ever since the market bottom back in late 2022, tech has been in an uptrend. You can see we've been outperforming energy for over a year. So that's very positive, saying risk on, tech stocks are performing. Now you'll notice that the energy sector has outperformed as the NASDAQ has kind of stalled. Over the past few weeks, you can see tech has underperformed energy, and I blew it up over here. Since January 22nd, energy stocks have been rising, or in other words, tech stocks have been falling on a relative basis to each other. So it's very short term. I don't think this is really the start of a big boom in energy stocks because the tech uptrend is still in place. We could come all the way back to the line and still be in a tech uptrend. Some more sector relative strength. The XLI is industrials, XLB is materials. And you can see here, these are really some of the reasons the S&P is outperforming. New highs in the XLI, new highs in materials, and I've just given you a couple of the flavor of the types of stocks. Steel stocks have been performing well. They're at new highs. And even looking at small cap materials. I know we look at small cap growth stocks have been struggling. I'm going to look a little further at that in a moment. But small cap stocks in the materials space, and here's a sampling, these stocks are at new highs. So that's why the S&P is showing that it's actually the leading index right now, and the Dow Jones Industrials. So let's look at the small caps, the Russell small caps. This is the the IWM. We've been all waiting for this to really launch into a new breakout, a clean breakout, and to start moving because that would support risk on. Now, long process here, almost 2 years of basing with resistance zone I've shown in yellow. And you'll notice that every time we think we're going to go, we pull back and we get a failed breakout. Got another attempt, we failed breakout. Another attempt, failed breakout. The last one here, looks like it's gotten a little bit of support at the old prior zone here. So, the IWM seems to be trying to establish an uptrend, but it's certainly a choppy and sloppy uptrend, if at all. So we'll keep our eye on it. It's been difficult to get this moving into a more accumulation type uptrend. So let's wrap up. Looking at the overall move, the February, the Fed, not the February, but this should say Fed. The Fed sparked a pop on Thursday with some of the dovish comments, but not getting the kind of follow through I'd like to see on the NASDAQ. And that's a concern. If the Fed talking dovish doesn't create a rally, a sustained rally, I'm not sure this market is going to go up. It seems like it's going to correct because that's good news and we didn't move much, but we'll have to watch it. S&P is much stronger, much healthier. So far, all the support levels are holding. The indexes are holding their 20-day, which is, again, the power trend is still in place. We're all closing. We're not closing below that today. We're above that. So that's still good for the market. We mentioned that new lows are drying up, starting to dry up. So that's constructive to help provide some underpinnings. The leading stocks, the leaders that had paused are snapping back to new highs like tennis balls. So that's good. Question is, can they hold those highs and move higher with resumed buying on a sustained basis by the institution? That remains to be seen, or is it just a 1 or 2 day pop that we got off the Fed meeting? For an exposure level point of view, we have to be flexible here. We are moving to new highs. Some of the leaders are moving again. So I think you want to increase your exposure a little. I believe I moved this up a little bit more than it was last week, just to be flexible with the evidence that we see on our instruments. So throwing some fishing lines in the water here might be the thing to do. Take a few pilots, but I would start small to start. The very, very fine line between having too much exposure and getting hurt on a pullback, or it's just as risky sometimes to have too little exposure when the market is resuming its uptrend and maybe making a bull leg higher. So we don't want to be flat-footed and have no exposure. So increasing it a little bit is in order here just to be flexible, but have your stops in place in case we do get an air pocket and the market reverses hard. We want to be able to react quickly to take off exposure. So the quote of the week is from Mark Douglas from his book, Trading in the Zone, a real great read. You have to read it if you haven't. Success as a trader cannot be realized until you develop a resolute, unshakable belief in uncertainty. The market is very, very uncertain. All you can do is manage your risk and really accept that uncertain things can happen. Just protect yourself with stops and be flexible if things start to go the other way. But it is true that until you really accept this, that you don't control what the market does, you will struggle. You'll fight the market because you think you want the market to do something and you don't control that. All you can do is control your position size. You control when you take a trade, but there are risks and there's uncertainty. That's the general market update for Friday, the 22nd of March. Have a great weekend, everybody. We look forward to seeing you again. If you're interested in my new website that will be coming out in the end of May, just send me an email at support@rainkinginsights.com. You might see the site posted once in a while. I'm trying to test out some things, but the site won't be launching until the end of May. Take care, everyone.